and thank you, Lindsey and Andrew, for having us. We always look forward to speaking to this audience. And like Lindsey said, I know that there's a lot of questions today. And so one thing that we want to do is, as we go through our agenda here, that we talk about the major questions that are really specific to client portfolios, and spend a little bit less time maybe on big picture and more time on questions. So I'm going to go through some of this in a little bit more speed so that we have more time here at the end. And then, of course, want to hear your feedback and your questions as we go throughout. Now, here we are. It's July 17th, and it has been a surprising start to the year, surprising by an economic perspective, and then also surprising by a market perspective. The economy is still moving along despite the 10 interest rate hikes that we've seen so far. The Federal Reserve is at last meeting paused on raising rates again, but made it quite clear that that was not to indicate that they are done raising rates. We still see the positive of wages have gone up, which is leading consumers to continue to spend. Job gains and real wage growth have created a resilient consumer. Everywhere we go, consumers are spending money. But the labor market is still the primary concern for the Federal Reserve, as increased wages are leading to more sustained inflation. And again, why they're likely not finished with their plan to attack inflation. Now, on the equity side, earnings for the S&P 500 are forecasted to be negative in the second half of this year. But when you look at the S&P 500, you certainly wouldn't expect that based on how we've had a strong rally. The US economy continues to be stronger than international markets, Europe and Asia particularly, and our geopolitical views and risks are unchanged really at this point. The risks are still elevated. We're going to talk through our investment strategy in more detail. So I'm actually just going to move ahead and talk about the table of contents. Again, would love to hear your questions throughout, and we'll address a couple of questions as I talk through the data. So, for example, let's start with the market. Last year was a tough market, and we know that. Last year, we essentially had a drop in the S&P 500 of 18%. You'll see that on the left-hand side in the light blue bar here. The NASDAQ was down about 30%. Bonds were also down about 13%. This year, we have seen a pretty strong rally in the market, but interestingly, that rally has been almost exclusively tech stocks, the 7 tech titans: Apple, Amazon, Microsoft, Nvidia, Facebook, Google, and Tesla are leading the market forward. Now, there have been a handful of Wall Street Journal articles about, if you look around at stores and airports and hotels, and then you look at the market, you would think everything's great, that we're not having any issues. But as money managers, as we're digging in a little bit closer, what we're seeing is if you take away these 7 companies, the rest of the S&P 500, so 493 companies, are up 3% through June 20th, and the entire market up 15%. Well, what is that saying to us? That's saying to us that the market is not reflecting the broad economic changes that we've seen, but that technology stocks are on a strong rally. Now, this is not too dissimilar from 2020. In 2020, we saw 5 stocks leading the market forward, the FANG stocks. But 2020 was a different year, right? We had low interest rates. These companies were spending more, hiring more, and they were real benefactors of the COVID environment and the COVID lockdowns. This year, we have higher interest rates. Their earnings are coming down. Their spending is coming down. And yet investors are still flocking to tech stocks, primarily because of AI enthusiasm some of which we think is reasonable and some of which we think is maybe unreasonable, and some of a tilt towards a risk-on strategy. Now, we still think there are opportunities in the market, but you can see here we have a very lopsided market so far this year, where the combined 47% of the S&P 500 by weight is tech, communication services, so like Google, and consumer discretionary. The more defensive industries, materials, utilities, energy, consumer staples, financials, you'll see here have had flat to negative returns for the year. So we're in a very interesting market. Now, where are the opportunities? Well, clearly, if we're just looking at stock returns, the opportunities would be in these more undervalued areas, the more defensive stocks. The other thing that's really important to note is that in this rally that we've seen in the market, the tech sector has contributed to 60% of the total return. This is the largest one sector contribution to return, really, that we've ever seen in the market. That even in 2001, right, when we saw the tech sector contributing total return in the market 31%. So tech has gotten larger as a larger weighting in the S&P 500, and it's having a more significant impact on overall returns. Now, we like these tech stocks. We think there are opportunities there, but we also think that there's reason to look outside into other industries and find the opportunities that are available in assets that are less overvalued. Now, we have a lot of questions about ChatGPT, about AI. We're going to talk about that in more detail, but certainly that enthusiasm has propped these tech stocks up. When we step back, though, and look at the overall S&P 500, one of the things we also see is that, broadly speaking, the S&P 500 is overvalued relative to where we've been historically on a price to earnings ratio. Now, what that means is that investors today are willing to spend more to buy stocks relative to how much those stocks are earning than they have been historically. Not unlike the late 90s. Now, many of you, of course, were invested during the tech boom, and in 1997 and 1998 and in 1999, there were a lot of comments made about the market being overvalued. Alan Greenspan famously said there was irrational exuberance in the market, and yet investors kept flocking to overvalued stocks. We are being quite careful to not do that. The reason why is we want strong, solid companies with good cash flows, with solid investment theses, and with good management, not enthusiasm only, or not even enthusiasm that we have to pay a high price for. Now, in 97 and 98 and 99, if you had a slightly more conservative money manager, you might have been disappointed in some of those returns. But once the bubble burst and we had 3 years of negative returns, that's when that more conservative approach paid off. Not unlike what we saw last year, where with CNR, our more conservative approach last year, having more value-oriented stocks, protected portfolios on the downside. So when we look at the market today, we're reminded of Warren Buffett's commentary that getting good returns is easy. You just have to buy good companies at good prices at the right time. Turns out that's not that easy, but today we are hesitant to hop on board this rally and assume that we're completely out of the woods. Now, in 2020, when we saw the 5 tech stocks again rallying in the market, what we saw was that they were spending more, like I mentioned, they were hiring more. Their earnings estimates were increasing. When we look broadly at the market historically, and we look at bear markets, so last year would have been considered, a bear market, where from the peak to the trough, we were down about 27%. Now, in every bear market since 1956, there has been a rally, a bear market rally. Now, many of you might remember this. We were talking about this a lot in 2020, that it's normal for markets to rally before they fall again and find their bottom. It didn't happen really in 2020, but that was because we had all the stimulus coming into the economy. But we don't have that this year. In fact, we have the opposite. So this idea, are we in a bull market? A bull market is when the market is growing consistently across industries and really reflecting an economic expansion. A bear market is the reversal of that. But inside these bear markets, like if we look at 2000 tech bubble burst or the 2008 global financial crisis, from peak to trough in 08, we saw the market drop 57%. But during that time period, there was also a 27% rally. So what I'm trying to get at here is that there are absolutely opportunities in the market. We're looking for those opportunities, we see them, but the opportunities are actually in those positions that are on sale. That's more of the more defensive, more value-oriented, even dividend-paying stocks are down for this year. When tech stocks and high growth, high price to earn ratio companies are really pulling the market up. So even though we've had this very impressive start to the year, until we see market recovery across industries, we are hesitant to jump on that enthusiasm, because what can happen, and what has happened every year, every time, not every year, but every time we've gone through this, is that we've, if investors jump on board and get on this this bear market rally, they then write it down again. And so we're not enthusiastic about jumping on board until we see more fundamental recovery and fundamental support. So some of the things that we are that investors and asset managers are looking at are, what are the things we're watching for? Where are we looking for those opportunities? So Jesse, I'll turn over to you to talk through what are some of the things that investors can look at that we're watching for to determine where we want to be invested, where we have concerns, and also where we have opportunities.
Yeah, thank you, Rachel. Well, one of the questions that we get often has to do with the banking sector. And of course, earlier in the year, we saw a lot of volatility as it pertained to the failures of First Republic and Silicon Valley Bank, and even the acquisition of Credit Suisse. Now, really important for all of you that are listening, is that for our clients here at CNR, for all of you, we didn't have any exposure to First Republic. We didn't have any exposure to Silicon Valley Bank, or even Credit Suisse for that matter. But there was concern overall about the soundness of the banking system. And we've continued to keep our eyes on them. And we don't think that there is a contagion, or that the scenario that unfolded really was in any way similar to, say, 2008. The difference in what occurred earlier in the year is that the banks did not have the same type of advice that Lindsey and Rachael and I are always talking to you all about, which is really having a diversified portfolio. And these banks that went under did not diversify their client base, and they had a very concentrated exposure to very high risk areas of the market, which are venture capital and startup, and they really mismanaged their businesses. And so it's really why we did not see broadly this kind of overflow into other banks, because other banks manage their business much better than we saw these several ones that failed. Additionally, what we saw in 2008 is that a lot of the banks had toxic assets. They were invested in securities that were essentially worthless. And the difference this time around is these banks actually were invested in very high quality securities. The problem is that they misaligned their assets with their liabilities. And when depositors wanted to go and withdraw their money, they didn't have the liquidity available. And in order to meet that demand, the run on the bank, as it's called, they had to sell securities at a loss. And that's what kind of created this snowball effect in some of the concerns with the banking sector. Now, as we continue to monitor what's going on in the banking sector, and some of the questions we get has to do with commercial real estate and commercial banking. And what we have seen is that banks are starting to slow down in some of their lending. And that's notable, particularly with some of the credit restrictions in commercial and industrial loans. So when we look at commercial banks, really, if you look at the right-hand side of the chart here, we're looking at the negative commercial and industrial dark blue bar chart is where we really see changes in loans, and that banks are not lending as much in this area because of some of the higher credit requirements and some of the concerns that are out there as it pertains particularly to office and office commercial real estate. So when we look broadly across the industry, we're seeing banks loaning less. And this is not a concern from the standpoint where we think there's something systemically at issue, but it really is more reflective of our view, why we think the economy is going to continue to slow down, and we're likely going to experience still a mild recession, because the banking sector is such an integral part of a growing economy, and our economy runs on credit. And so what we've observed in prior periods where banks have higher credit standards and credit is starting to become tighter, we often observe that this also creates weaknesses in the labor market. And just logically, it makes sense as there's less loans available and maybe not enough for reinvestment or to fund certain projects. What ends up happening is that there will be a slow decline in the payrolls. And we're starting to observe some of that within the data. And so this is just more information and data points to support our view that things will continue to slow down, and we will likely have a mild recession as a result of some of these things that are occurring within the banking sector, but also more broadly, some of the economic impacts from interest rates and other things that Rachael already mentioned in her opening.
Great. So on that topic, right, have the banking issues subsided? Well, not completely, right? I mean, we still have a lot of pressure on banks because of higher interest rates. Still have a lot of pressure on banks if they have loans against large commercial real estate downtown San Francisco. But this is why it's really important that we understand what we own, right? So investors should be wary of not knowing what kind of risk is in their investments. That is one of the reasons why we own individual stocks primarily, is so if we own a bank, which we have a couple of banks in the portfolio, are they still paying their dividends? What do their loans look like on their balance sheet? This has been a scenario where bank stocks have kind of all been hit, particularly those mid-sized regional banks, even if they're perfectly fine because of this contagion and this fear. So we are paying attention to that quite closely. Depositors, though, if you're a depositor and you're putting your money into a bank, we don't think that there's a high risk there that you're going to lose your deposits. But for anyone who has a good amount of cash on the sidelines, the better question, I think, is how are you using that cash to work for you? And I know Lindsey and the team have a number of solutions for cash. But if we're talking about your standard savings at your local community credit union, your mid-size or regional bank, or your large bank, we do not expect that what's happened in the banking industry so far, that's going to be a threat that you need to be worried about taking your money out of the bank. But the Federal Reserve is certainly monitoring the pressure that they have put on banks. Because as we look at the economic impact of what they've done, is they have intentionally raised interest rates to slow down the economy. right? So GDP is slowing down. That is a clear expectation from an economic perspective. That impacts corporate profit growth. But the positive is that inflation is coming down as a result. This is all part of the plan and going as they would expect. But it means that they are slowing the economy. These red indicators are indicators that the Federal Reserve stepped in and turned red. Monetary policy, yield curve, interest rates, credit demand, right? So increasing interest rates means that the willingness to go out and borrow money comes down, as Jesse just mentioned. And that is what helps bring money out of the economy. The good news is that where we were peaking at 9% inflation, that has been coming down. The Federal Reserve has a target of roughly 2% inflation. That's the number that economists believe is the right number to get investors to invest, but not also that also they are rewarded if they're saving. So we still have some way to go. Now, these yellow indicators are the rest of the economy falling in line, right? That it's doing exactly what we would expect it to do. It's not a roaring economy when we have 10 interest rate hikes. So the impact that the Fed actions have had against the inflation have started to impact the economy. Now, this is very different than the market, right? The market is a forward-looking indicator. The market is pricing in where the economy is going. The economy is a lagging indicator. We look at it in hindsight. So a recession, are we going into a normal recession, a mild recession, or no recession at all? What does that feel like for a typical consumer or an investor? So two different things. Let's address first the consumer. The consumer in the US has been in a very interesting spot, because in 2020, we started saving a significant amount of money. In fact, we accumulated, on average, about $2 trillion of excess savings. Well, where did this come from? We weren't taking the trips that we normally take. We refinanced homes, payments went down. Maybe you got a raise. Maybe you got a PPP loan. Maybe you got a stimulus check. Maybe you were on unemployment and you got a raise. And savings increased significantly. And we have been spending that. We've been drawing down those excess savings. So if the question is, well, we keep talking about this recession, and yet everywhere we look, everybody's spending, we are. But how long does that last? Our view is that households have a couple more quarters of savings available to support spending, but consumer spending is the primary driver of our economy, right? 70% of US GDP is driven by the consumer spending. As that has been resilient, that has helped the economy continue to grow. As that gets tested, we would expect to see consumers start to spend less. Now, companies are expecting this. Their earnings estimates are going down, right? So outside of the tech stocks, that's why other stock prices are down. Earnings estimates have been coming down as we anticipate higher interest rates, less consumer spending is going to lead to lower profitability for companies. It's just not, it's kind of slow. It's not coming as quickly as people expected. Spending has a primary driver for that reason. The second reason, I'd say the most important thing the Federal Reserve is looking at is the labor market. We still have just too many jobs available. Now, that sounds counterintuitive. We want jobs available. The Federal Reserve wants unemployment to be low. But what they don't want is companies having to pay more and more money for each hour of labor, because that increases their margins, decreases their profit. And once you get a raise, it doesn't really go away, right? But again, back to the market, earnings are what the market is pricing in, forward-looking earnings. And so when we look at the labor market, what we see is that we still have about 1.7 job openings for every one person on unemployment. And that means that companies are competing for labor. Costs have gone up. So what does it feel like as a consumer if we go into a recession where you've gotten a raise, where there are jobs available? That might feel more like a mild or non-existent recession, but the definition of a recession is much more technical than that. And one of the things we've been saying all along at CNR is that we'll likely experience a mild recession, which if you have a job or if you have wages that have increased, you may not feel it. Now, we're not going to know if we went through an official recession for another year or so when it's all looked back in hindsight. And the determination is, yes, we were officially in a recession. And what I would say is the most important thing is we're not going to see the real impact on inflation coming down closer to that 2%. And Jesse will talk about this in more detail until we see the labor market softening. But the Federal Reserve also sees, and Jesse already went over this in terms of banking and labor, that as we see interest rates increase, loans to small businesses have been declining, and therefore there's and the costs have gone up, so therefore there's less funds available to hire more, and this is a precursor to recessionary environment. Why this matters is the number one employer in the US is small businesses. We might hear about layoffs at tech companies. It's kind of a drop in the bucket. It's the small companies that are the primary hirer of our labor. And so higher interest rates have a big impact on those small businesses. And so we do expect that it is going to impact the labor market, and that is the Federal Reserve's goal. So to be clear, their goal is to have higher unemployment, right? Now, they would love to have full employment without wages going up, but that's not working for them. So they're raising interest rates, knowing that this is going to lead to layoffs. It's going to lead to fewer jobs available. And that intent is to slow down the economy. A slow growth, a mild recession, or a normal recession. We still think the highest probability is a mild recession. Again, what it would look like is either the economy not growing or shrinking slightly. To put this in context, in 2008, we saw a 6% drop in GDP, a contraction of 6%. What we're talking about here is roughly a 1%, 0 to negative 1% GDP number. Once we get our GDP numbers and they're revised and we find out next year, we might be in a recession today. We might experience one between now and the end of the year, but it also might be mild enough that we don't feel it. Now, a normal recession is more like 1 to 2% contraction. Again, nothing like 2008. But with a strong consumer and a strong labor market, the Federal Reserve is in a very tough spot because they want to keep inflation coming down. And they've said very clearly, we will do whatever it takes to bring inflation down. And so far, it's been working, but they still have some room to go. And Jesse, I'll let you take over and pick us up there.
Yeah, thank you, Rachel. And it's interesting because we see what's going on, and Rachel explained there's still strength in the labor market, the consumer's still spending, but yet we kind of have this outlook where we still expect a mild recession. And what's really going on there? Well, it's actually just this past quarter where we've seen and observed that interest rates have finally got to the level at which they're starting to constrict the economy. And so what you observe here on the far right is this little red circle that shows the real federal funds rate is we're just starting to get into that restrictive territory. And up until recently, the level of interest rates were still, in some regards, stimulative to the economy. So as we continue to move forward, we feel that the effects of the Fed's tightening on economic growth is going to be more apparent in the coming months as we move forward. And what this likely means is that the recession is not completely avoided, but it is taking a little bit longer and delayed to where to get to where we are expecting it to be. Rachael also talked about this dislocation in the labor market and how many jobs are available for people that are unemployed versus the people that are unemployed. And this dislocation in the labor market is also part of the challenge that the Fed has in order to help bring down inflation. And inflation has made some good progress. This dark blue line here you see in the summer of last year was over 9%. And with the recent numbers that we got, dropped down to about 3. But the Fed is looking at an inflationary number that they call core inflation. And that takes into account some of the stickier components. And one of the biggest ones that Rachael already alluded to really is the wage growth and the wage pressures that we've seen. So in order for these pressures, these inflationary pressures that have been brought on by some of the wage growth and dislocation in the labor market, it is very likely that the Fed is going to continue to hold interest rates higher for longer. And potentially, we've heard some signaling that they could even go a notch or two higher from where they are, because they really want to make sure that inflation continues to trend downward and that we do get this wage growth back down under this 4.8% or so, where it's averaged since 2020. Now, the interesting thing as well, and kind of gives more buttresses the argument that the Fed is going to continue to raise rates, or at least hold them in this restrictive territory, is they've actually recently upgraded their view of the economy. So as Rachael was talking about these articles and that we've seen where people are out and traveling and hotels are packed and airports are packed and restaurants are packed, well, the economy still has this resilience, and the Fed has upgraded their view of the economy recently, and upgraded their view in terms of growth, in terms of unemployment not raising as high as initially expected. And as a result of that, the Fed is going to have to keep interest rates at this higher level. And the market, the futures market, is now finally starting to price in these higher levels of interest rates. CNR has had a non-consensus view that rates were going to remain higher for longer. And now finally the market is actually starting to price in and believe that because of the resilience that we've seen, interest rates are going to have to remain a little bit higher. And this is all pointing towards our view that things will continue to slow down. Part of what the Fed is in the process of doing right now is what is called quantitative tightening. And you might have heard earlier throughout the pandemic, there was quantitative easing was being thrown around. And essentially what that jargon means is when the Fed is easing, they're essentially stimulating the economy and putting money into the system. And when they're tightening, they are removing stimulus from the system. And so as they continue to remove stimulus from the system in the process that is occurring, it is similar to, equivalent to, almost another full percentage point of interest rate hikes. And so this dynamic that they have, where they are no longer going out and stimulating the economy, and the way that they did that mechanically throughout the pandemic was going out and buying bonds in the market. And so when they went out and buy bonds, they're essentially putting cash into the system. As those bonds mature and they're no longer buying them, that is restricting the stimulus and pulling money out of the system. So this is just another indication in our view, and another data point, that interest rates will remain higher and things will continue to slow down. But this is also going to help bring the inflationary pressures that we've seen continue to come down to the target range that the Fed is looking to achieve. when we look out across the globe and consider areas of positioning and investment, and we look at the developed economies, Europe and Japan relative to the US has performed the best coming out of the pandemic. And we still favor the US when we look at opportunities around the world, and whether it's international developed markets or emerging markets, we still think that the US is the best place to be invested and presents the best opportunities because of the way that the US has responded very aggressively on the fiscal and monetary side, and how they are fighting very aggressively as well to help stave off some of the inflation that we've seen and other developed markets are also seeing. And so I love the way that Rachael says it, so I'm going to steal her line here. But when we look across the globe, we still think that the US is like the best house in a bad economic neighborhood. And this is what we're showing here in the data, is that the US, which is the dark blue line on the left, has declined significantly in terms of the inflation, and we're in a much better position than some of our peers in Europe and the Eurozone. And also, we've done the best job in terms of raising interest rates and being very aggressive to get inflation under control. And so when we consider, for example, China is actually in the opposite position, where they're cutting interest rates and trying to stimulate their economy because of some of the issues that they have. So we'll still favor the US when it comes to positioning. We still think that those are the best opportunities right now when we look across the globe. At some time, the calculus will change, and we'll look to be adding exposure to different markets when we feel that there's better opportunities. But for right now, we do feel that the US is the best place to be. But I'll let Rachael unpack a little bit more where we're positioning portfolios and seeing opportunities.
Great, thank you. And I think that that's really the key when we think about how is the US doing relative to the world. The fallout from COVID, inflation, the Russia and Ukraine conflict. Despite the fact that we're talking here about the US economy contracting and going into a recession, this is really a policy-driven recession, right? This is the Federal Reserve stepping in to control inflation, and they've done it aggressively and quickly, and relative to other regions around the world. We think that because of that speed and because of how focused they've been on it, we're likely to come out quicker and fare better, meaning how do we recover going forward with our economic engine? Now, the timing of when this is all going to happen obviously is up in the air, but our best thinking shows that we expect economic activity to start bottoming when we see the US consumer spending down those savings, with the impact of higher interest rates impacting lending. And between now and the end of the year, we should see that bottoming of economic activity. Stock prices, you already paid for this last year. What I mean by that is your portfolio was down last year in anticipation of a recession this year. So what we're not saying is that for the economy to go into a recession, that if that happens, or when that happens, it doesn't mean the market will also drop another 10 to 20%. Again, the market is a forward-looking indicator. The market will recover before the economy recovers. But that being said, when we look to where are the opportunities, we want to make sure that we're not getting ahead of ourselves and anticipating a recovery before we're out of the woods. Like I showed you that bear market rally, those periods where the market rallies and then falls back down. We're really looking for fundamental recovery before we want to take on more risk. Now, when we talk about performance of portfolios and we think about returns, because this is now really a new world we live in 2008, the last time we saw a true recession. Now in 2008, that wasn't even a normal recession. That was the global financial crisis. The iPhone had only recently come out. I was still using a BlackBerry. Most investors had to go onto their computer to get an update on the market. Well, now we get fed market returns and market information all day, every day. Still not so much on bonds, but now we're in this environment where the market's up 17%. I have an expectation that my portfolio should be returning the same as the overall market. Now, many of you are not in that camp because you've been well educated by Lindsey and the team at McKay Wealth Management. But one of the key points is bond performance, right? Now, this is something that's harder to track. Bonds last year were down. For the first time in history, stocks and bonds in the same time period were down double digits. The good news is we're seeing recovery there. 2 to 3% return so far this year. It's still bonds paying their income. Now, bonds, of course, are an income driving return. 80% of returns in bonds come from income. The price of bonds can be sensitive to interest rate movements. As interest rates move up, bond prices come down and vice versa. We do expect bonds to continue to pay their interest. No changes there, and bond prices have been recovering. They're starting to be more traditional. Last year, what we saw was a very untraditional environment. When we look at cash management, this is something that's really important. I'll just make a comment on. Now is a good time, for the first time in a decade and a half, that if you have cash, it's not a bad time to buy T-bills, not a bad time to put that to work. When we look at liquidity management, so say you have, I'm just going to throw this number out there, say you have a $500,000 tax bill and you know you're going to have to pay that in April. Well, you could buy CDs, you could stay in a money market fund, you could go buy T-bills, commercial paper, the variable rate demand notes, that's what VRDN stand for. And what we're seeing broadly is we're seeing some good returns coming out of fixed income. Now, one of the questions we often get then is, well, then why don't we put everything into T-bills? Why don't we just get out of the market? I'm happy with 5%. Let's put that to work. You know, treasuries were paying nothing to very little for the last decade and a half. Should we be buying more short-term treasuries? Our answer is yes, we think so. We have been adding in client portfolios short-term bonds. When do we want to go longer duration and locking in some of these higher yields? We think soon is likely the answer, but not yet. Why? Because we still don't have inflation under control. We still don't have a clear picture of the peak of higher interest rates. We still don't want to go 20, 30 years out for long duration, but medium term is looking more attractive. The one thing I would say is that that commentary of should we go buy a treasury or a CD that's paying 5%, think about that on an after-tax basis. That's really key. CDs are taxable, right? So if you get a 5% CD, if you're paying your federal income tax, and for those of you who do pay state income tax, you might lose 40, 50% of that yield to taxes. There are some other options if you have a more significant amount of cash. The other thing is that 6-month treasury bills are attractive, 12-month are attractive. You go out further than that, we're starting to see lower interest rates. So we do want to lock in some of these higher yields, but what we don't want to do is lock in too much when there is still inflationary pressure. So going back to the economic comment that Jesse made, it is my favorite comment. When we look at Europe, we look at China, and we compare that to the US in our view is still in the most resilient position. Is it time to start looking outside of the US for investments? We don't think so. If you look at the past 5 years as an example, the US has significantly outperformed emerging markets in Asia and developed markets, the MSCI EFA, as you can see here. We don't see that that's changed. If anything, it only supports our determination more after 3 years of harsh lockdowns in Asia and Europe with a war in the back door, high inflation, very difficult labor market, worse than we're even experiencing here in the US. Now, where do we think there are opportunities? value stocks, dividend paying stocks. Last year, they were the belle of the ball. The only place to be for positive or flat returns were dividend stocks. This year, they're down. Now, that's a normal sector rotation. It also has to do with some of what's happening with bank stocks, but we actually think these are undervalued. If you compare that to the S&P 500, where we've talked about this before, more of an overvalued zone. So we are being very careful there. I do want to make one comment on AI, Chat GPT, and these other buzzwords around AI that are really driving the S&P 500 tech returns. Is this the next big thing? As investors, should we be invested in companies that are participating here? And the answer to this is yes, absolutely. We're excited about AI. We think that Google and Microsoft and Apple, we're going to see some real progress, which is great news for innovation, technology, for the economy. We're certainly going to see some fallout, much like we did with the internet, job changes, low skilled jobs being replaced by technology. But on the other hand, what we don't want to do is we don't want to invest in speculative companies, right? So if we look at Microsoft and Google, which we own in client portfolios, part of their stock appreciation has been because of AI, because of ChatGPT, because of these advances. We think the best approach at this point is to gain access to this innovation through the large tech companies. That being said, we have to be careful, right, that a tech bubble is not being created based on enthusiasm that's not supported by earnings. So this overvalued zone from S&P 500 stocks, primarily technology, we want to be careful. On the right-hand side here, you'll see post-tech bubble, it's value stocks that tend to outperform. So diversification is still key. Yes, we're looking for opportunities there, but we don't want to jump on a bandwagon until we feel confident. And as you always know with CNR, you are going to hear a more defensive, a more conservative approach. And that's because our clients primarily don't want to lose the money they've earned, lose the money that they've saved and you've all saved and worked so hard for. Of course, we want it to grow. Of course, we want great returns. But when there are speedometers that are only red and yellow, we think it makes sense to be modestly defensive. Now, that doesn't mean we're out of the market. It doesn't mean that we're not looking for that growth. But what it does mean on a risk reward perspective, because really we're risk managers at the end of the day, that the risks are high enough that we're going to have a mild recession, that the Federal Reserve is not done and they're not cutting rates, that there's still some potential economic pain, that we want to be modestly defensive, remaining focused on high quality stocks in the US and buying companies that are at good prices, that are well managed, and still have opportunities to grow. So with that, I'm going to turn the time back over to Lindsey and would love to hear any additional questions that have come through or anything on your mind that we can answer.
Great. Thank you, Rachel and Jesse, for your presentation and thoughts. Andrew has been managing some of the questions that have been coming in. I know we addressed a lot of them in the presentation already, but Andrew, are there any additional questions that we would like to pose?
Yeah, that was great. Thank you so much. We really hit on a lot of the questions that had come up kind of in advance, like you talked about. I just want to clarify, there was one question about fixed annuities. I know we talked about short-term treasuries and CDs and weighing the pros and cons there. For the person who reached out about that, I want to make sure just to clarify that we'll be following up with you about that specifically, but just want to make sure that didn't go unnoticed there. For other questions that we maybe didn't address, can you talk about kind of looking forward? I know you talked about kind of where we are. Can you talk about more into 2024? Is it too early to sort of prognosticate what could be? Are there any tea leaves to be read right now, or is it just kind of a wait and see with everything going on that we're seeing with interest rates and inflation and recession and will they, won't they kind of thing?
Yeah, great question. And thank you for reminding me to touch on that, because we don't think that we are forever, right, in this contractionary or recessionary environment. In fact, the sooner we can get to an economic activity bottom, the sooner we can come out of it on the other side. At this point, we do think 2024 looks better. We think 2024, we should see economic recovery and growth. The caveat I would make is that, again, this is a policy-driven recession. It's going to be a policy-driven expansion, meaning that when the Federal Reserve decides that they have gotten inflation under control enough and they start cutting interest rates, that's when we're going to see more economic growth. But we do expect 2024 to be more positive. Now, that's on the economy. Again, that's not the market. The market at this point, so S&P 500 through today is up about 17% for the year. Now, I think everyone on this call, Jesse and I especially, would be enthusiastic if we were going to get another 17% between now and the end of the year. And if we just keep on this path, we think that that's unlikely. So if we're not going to continue to see market recovery between now and the end of the year and bull market going up, what are we going to see? Probably some more volatility, probably uncertainty around Fed fund rate hikes, volatility around, and of course, any geopolitical news, but just of what we do know, inflation numbers, jobs data, and the Fed minutes and any interest rate hikes. That's probably where we're going to see the most predictable market volatility. And then, of course, if there's anything unpredictable that happens from a geopolitical perspective, that could create volatility. Now, here's the thing. If the market continues to go up and that spreads out across different industries, and it's not just technology, well, then we might change our tune here and say, okay, we are seeing a broader recovery across all industries. We're not seeing that today. What we're seeing is that the majority of the market is telling us what we think is true, that the economy is slowing down, that earnings are coming down. You take technology and those 7 companies specifically out of the picture, we're in a very different world. If we were on this call and the S&P 500 was only up 3% this year and earnings estimates were all down, I think it would feel more consistent with our economic outlook. But what's happened is those tech companies have really caused a divergence between our economic outlook and the market today. So it's going to have a lot to do with what happens with those companies, those stocks. They probably will continue to go up with AI enthusiasm. But again, volatility around those fundamentals is probably where we're going to get. We do think, though, that by the end of the year, this is still a positive market year. We expect your portfolios to be positive with income and bond market recovery and stock market recovery, as we've already seen. We do think this is a positive year in the market. And 2024 should continue, assuming that the economy gets through the bottoming and starts recovering next year.
Great. Thank you, Rachel. Appreciate the additional insight. And I think that a lot of what we're feeling or hearing is just that there's a lot of going back and forth. Yes, we're going to have a recession. Well, it might be a mild recession. No, there might be a recession. I think that's part of, as an investor, it's challenging to filter through all of that and have a good understanding of really where things are headed. And I think what I'm hearing you say is you're making the best decisions that you can based off the information that is available and making changes as things progress and more information becomes clearer.
Exactly. And one more point on that, because I think you're absolutely right, is that part of this confusion is this unexplainable impact of stimulus, right? Where did all this money come from? Why does everyone have all this money to spend? And the answer is stimulus, because you don't see it, but it has a silent hand, right? Now, taking stimulus out of the economy is the same. We don't see the money going out. I mean, maybe we do when we go to the grocery store, right? But it's these silent impacts. So it's not necessarily easy as an investor to be able to decipher all of this data. But for those of you who are with CNR, that's really what you're hiring Jesse and I and our team and the hundreds of people behind us, is to take all of this information, look through it through the lens of an investor, and say, okay, which companies are best situated, are best managed, and able to come through on the other side with growth, with consistent returns on a risk managed basis. And this is a unique time. So the fact that we're all feeling a little bit like what's happening is not surprising. We've never been through a global pandemic. We've never been through this much stimulus in such a short amount of time. And if the Federal Reserve raises interest rates again, that's going to be the highest Fed funds rate we've seen in 20 years. So this is a unique time period. Absolutely.
Great. Well, thank you again. I think that's a wonderful point for us to end on, that it is a unique time and everyone's situation and circumstances are unique as well. So for any of you on the call that want to review your individual portfolio holdings, your allocation, or really how we could expect your accounts to perform for the balance of the year and review how they've performed year to date, please make sure to reach out to a team member and we'll get a time scheduled where we can talk about your unique circumstances. But with that, I just want to thank everyone for joining, and once again, thank Rachael and Jesse for the time that they've shared today. And we will look forward to talking with each of you shortly, and hope that you have a great rest of the summer, and take care, enjoy the sunshine.